Hey, it's Jim, and this is level 3 of the CFA program, the Private Markets Pathway, and the learning module on preserving the wealth. We did part 1, human capital. Now we're going to do part 2, purchasing power. And of course, and I warned you about this in that previous recording, this is a conversation entirely on inflation, how it impacts purchasing power. In fact, the first paragraph or two of this inflation section uses some words like eroding future values and erosion of future wealth, makes families poorer, those kinds of terms. And then, of course, when we have a conversation about high net worth and ultra high net worth clients, they're likely to have investments scattered throughout the world. So we need to go back to our days of level 1 when we see the relationship between inflation and interest rates and the rate of exchange between and among currencies. So the focus is, of course, on inflation. There's a good question at the end of this learning module on the kind or the type of inflation. So you'll need to be able to identify, I think these are good questions here. So cost push inflation. That means that something inside of the business is pushing input prices to rise. So look at this: raw material costs, supply chain disruptions, increased wages. Think of that cost push inflation as kind of something that's internal to the business. The clear example of this, and there are two of them, but over the last decade or so, we've had lots and lots of volatility in commodity prices. We've had spikes in lumber prices. We've had spikes in copper prices. We've had spikes in peaches and apple prices. So all the business that use those commodities inside of their operations, they're going to experience this kind of inflation. And then, of course, the other side of that is increased wages. When workers say things like, you know what, I'm not coming to work today unless you pay me more. Now, of course, there has to be a compelling reason to pay the workers more. And then let's go outside of the business, and we'll call this demand pull inflation. This goes back to our economics days. Think of that demand curve and think of the shift in the demand curve. Remember all those different reasons for shift in demand curve? Things like changes in consumer preferences, increases in technology. So that's what that means, that the economy, right? Look at the causes: economic booms, oh my gosh, stimulus spending. I'm still scratching my head about all the COVID spending and wondering how much good that stuff did for us. It got us lots of inflation. So that's demand pull inflation. So be able to identify the difference between those two. And I'm guessing, based on this conversation that we just had, that when you get to that question at the end of the learning module, you'll jump all over it. And I quite honestly can't remember which one was the correct answer. Now, there's another concept that the Institute introduces this here: unanchored inflation expectations. So this occurs when there is persistent inflation over time. And so individuals and businesses start to think that, well, we've had inflation over the past 2, 3, 4, 5, 6 years. We're probably going to have it. Maybe we're going to go up. So what that means then is if we believe that prices are going to rise, that's going to affect our behavior today. Simple example is that if we think a loaf of bread is going to cost $1.20 next year and it only costs $1 today, well, we need to take a look at our interest rates. We need to take a look at our wage increases. Well, if those two things combined are not going to be more than 20%, then we're going to start buying lots and lots of loaves of bread today, which then drives up the price of a loaf of bread today. So the idea of the unanchored inflation expectation is this notion that regardless of the reality of economic conditions, that prices are going to rise because we expect prices to rise in the future. Yeah, how do we measure inflation risk? It's one thing to say, all right, I expect inflation to be 5%, therefore I expect to go to the food store and spend 5% more next year than I do today. And I can kind of adjust my consumption and my investment decisions based on that kind of an expectation. But remember, there's this concept of unanticipated inflation. What happens if we thought inflation was going to be 5% and we go to the food store and all of a sudden a nice fillet steak is $50 a pound instead of, whatever it is these days, $20 or $25 a pound. So you have this compounded effect of anticipated and unanticipated inflation. So we need some kind of a metric to do this. And of course, let's go back to level one. One of our favorite risk measures is beta. So we can compute an inflation factor beta, which you may or may not have to compute on the exam. I would be able to use this equation, but you'll probably have to interpret it and then evaluate changes in inflation and how that inflation factor beta impacts consumption decisions and investment decisions. So there we go. The beta between the rate of inflation and our investment return. The Institute uses the term goal there, and that's just a function of things like standard deviations and covariances and correlation coefficient. And so this equation here is just a little bit of a rearrangement of our formula for correlation coefficient and doing some substitutions. This is probably familiar to you going back to especially level 2 when we did hedge ratios, which we're going to do here in just a second. But that beta is going to be the correlation coefficient. There's that sideways P, let's call that rho. And then we multiply that by the ratio of 2 standard deviations, 2 measures of total risk. So think how cool this beta, this inflation beta is. And it's true for all betas. That in order to get, remember, beta measures systematic risk, so we've got to be a little bit careful here in our interpretation from the regular old systematic risk from an equity beta to the inflation factor beta. I mean, the interpretation in general is the same. So we take in the numerator the standard deviation of the investment returns, that's the term goal up there, divided by the standard deviation of inflation rates. So, think about it. During the last couple of decades, inflation was, let's say, 2%, and then 2%, and then 2.1%, and then 1.9%, and then 2.2%. What's the standard deviation? I mean, it's got to be super, super low when you have those. But then all of a sudden, let's go after COVID, and we have 5% and 7%, and then 9%, and then 8%, and then 6%. So now we have a much higher standard deviation of inflation rates. Now, down at the bottom, so let me repeat myself. Be able to compute that in the blue box, but look down at the bottom. This is really important here. I think this is the better exam question. If there is a higher beta, it means that the return, the goal of the investment portfolio, they move more closely with inflation. Now that should make sense because of that correlation coefficient, and then you adjust. So think about the correlation coefficient between the investment returns and inflation. Pick a number, say it's 0.5, but then you adjust it by the ratio of standard deviations to get this inflation factor beta, which is our kind of measure of systematic risk. Now, if you look at that illustration that we have over there on the right, you have the investment, and then you have all these arrows going out. I'm going to go ahead and sneeze. Man, oh man. Maybe I'm just allergic to making these videos. So what we're doing here in this slide is to illustrate the simple relationship between correlations and that inflation factor beta as they relate to volatility. So if we have high correlations and if we have lots and lots of volatility, then that inflation factor will be high. So this means that that investment return is going to be an excellent hedge against inflation. That's why we have bolded down there at the bottom, providing a hedge against inflation. Now, let me say something before we move on to that hedge ratio. Remember throughout the CFA program, we have this kind of a concept that, and we'll talk about this a little bit later in the slide deck, what's a good protection against inflation. Well, let's go ahead and buy gold. All right, that makes sense. Let's go ahead and buy peaches, or let's go ahead and buy chickens, or some commodity out there, because when inflation rises, then the price of those things rise. But it's a little bit more complex than that, and this is what the next section does for us. So what we want to do is we want to figure out what that optimal amount of hedging is going to be. So we're going to use what we did before, a little bit in combination with a hedge ratio. So notice on the left-hand side of the equal sign, we're going to call that the amount of the hedged asset, whatever that asset might be. And we'll talk about some of those possibilities here in just a second. And so this equation in red is exactly like we did with forward contracts and with futures contracts. We did some of this with swap contracts, and you could even do some option kind of hedging here. Although there's a different method of hedging with options in the with the delta of an option. But notice what we have in the numerator. We've got this target beta minus our kind of actual beta, and then we're going to divide that by the hedged beta. That makes perfect sense. Remember what we did in futures contracts. We had the target beta minus the portfolio beta, and then divided by the beta of the futures contract. I'm talking about an equity hedge, obviously. And then we're just going to adjust that by the currency, or let's say the dollar amounts over on that far right part. So there's the goal versus the hedge. And so this is going to give us the optimal amount of hedging assets. Now skip down to the bottom. If we want to eliminate inflation, what do? Well, we put a minus sign in front of all this stuff to indicate we're going to short some things, right? And then we're just going to take the ratio of the betas versus the ratio of the dollar amount, and that will get us an amount that reduces the portfolio to zero inflation risk. So let's go ahead and work through just a quick example here. We have a couple in Scotland and child age 8. This child is going to go to college, 4-year private university in Europe somewhere, and they're going to fund their retirement in Wales. So here we go, £50,000 in 10 years. So that's $50,000 every year for 4 years, right? So inflation rate 5% annually. And you know what? I would, if I were making up this question, I would say the expected increase in tuition 5% annually, or just say that this is private education inflation rate. Annual volatility 3%, and then there's a correlation with these European inflation-linked bonds. So we're told here in this particular case study that we're going to use these ILBs as our hedging kind of an instrument. All right, there's our $5 million longevity adjusted present value. Don't be upset if you had to calculate that present value, but you should be able to do that. Annual volatility of 5, and there's a correlation 0.5, other estimates, discount rate, and annual volatility of European inflation 3.5%. So we have two questions here. Determine that exposure to minimize inflation risk to both the education goal. So let's go back here. What was that? 50,000 in 10 years, and then the retirement goal, 5 million. And that's present value, right? All right, so we'll get out our trusty Excel spreadsheet. We'll do academic years. And down that left-hand column, you might do 10, 11, 12, and 13 if you want, but you can do year 1, 2, 3, and 4. There's the cost, 50,000 in that first year, compounded out by the 5% that I was referring to just a minute ago. Take that present value at 2%. So if you sum the present values, you get 171,451. Next, go ahead and calculate the inflation factor beta. So we're given that 0.4 correlation, and then the 3% for the investment returns, 3.5% for inflation. So there's our inflation factor beta of 0.343. Multiply that by, let me go back here, the 171,451, and what's our answer there? 58,808 pounds of those European inflation-linked bonds. I'm just scrolling back so you can remind yourself of those numbers that are given. How about the second part? Let's figure out this retirement goal. present value, we're already given that as the 5 million, right? So let's do the inflation factor beta. Now we have a correlation coefficient of 0.5, and the standard deviation was 5, and now inflation 3.5, so there's the same 3.5. So there's 0.71, multiply that by the 5 million, you get, what is that, about 3.5 million of European ILBs to hedge that inflation exposure. So I want you to think about this kind of like, it's not exactly, I want you to think about this, it's kind of like inflation immunizing a portfolio. So what do we have? Remember, we've had great conversation of goals-based stuff. So here we had this one goal to provide for the education for the client's child. Well, what are we going to do? Well, we're going to match, we're going to immunize by working through this process. And so the 58,808 of these bonds are going to get us to that goal. That should make perfect sense. Then here, 3.5 million of these ILBs is going to get us to our retirement goal. Goals-based, this is an application so that whenever we retire and whenever the child goes to college, we'll have, well, whatever those numbers will be, 5 million and then the 50,000 that grows at 5%. All right, so how can we do this? Well, skip down to the middle there. There is the inflation-linked bonds in Europe. There are other inflation-linked gilts, that's the term for the UK, and there are the Treasury inflation-protected securities that adjust the principal based on the consumer price index. Advantages of using these things: maintain real value of investments, just like we showed in that previous example. Now, the problem, of course, is remember that with immunization with a bond, we do that by matching duration and investment horizon, and duration is just the first derivative, and we need to worry about second derivative. So when you do that immunization strategy for the bond portfolio, you have to monitor it and evaluate it and adjust, right? Dynamic hedging, we talked about that back in level 2. And same thing here. That's why historical performance shows mixed results, but those mixed results become much better results if we monitor and adjust and do all those other kinds of things. Because, and let me just go back here, you know, this inflation factor beta for retirement, it might be 0.71 now, but after 3 or 4 years, it might be 0.61 or it might be 0.91. Same thing here. This might be 0.8 or it might be minus 0.2, right? So you've got to adjust. Here, let me go back here. You need to adjust that 3.5 million. You need to adjust that 58,000. So that's really the good answer on an essay question, is say, you know what, historically, we're not quite sure this works, but if we do everything that the Institute tells us, then we should be fine. We spent a little bit of time on the previous recording talking about annuities. I didn't spend too much time, but these things work really well. You always have to worry about the cost. Look down at the bottom. There we go. Higher cost compared to non-inflation adjusted annuities, which are higher cost than any other kinds of any other kind of manner that we can achieve these kinds of goals. You know, so why do we like these things? Because they're good risk management tools. They can show us everything that we learned in the CFA program about the relationship between inflation and investment returns and bond returns and everything that we learned about beta. What did I say just a few minutes ago? We could buy gold, we could buy peaches. So this is what I'm saying. We could go ahead and buy some of these commodities. We can do it by buying the actual physical commodity. I think I told you the story a couple of recordings ago. One of my friends from a long, long time ago, several years ago, he was tired of paying such astronomical prices for eggs that he bought a bunch of chickens. So he built a little barn in his backyard. He's got a bunch of chickens in there. So he has chickens, and if ever I want eggs, I can go over and just say, I need 100 eggs. And he goes, oh, I got these chickens out there. They're laying lots of eggs. Yeah, historically, that's what I was saying earlier, positive correlation with inflation. But then, and this is why we use that equation where we divide by standard deviation of inflation, because there could be high volatility, and that's probably not suitable. Real estate, we had this conversation just with private real estate, right? It's a good protection against inflation because as prices rise, that probably means that residential rental rates rise and commercial rental rates rise. So we can appreciate, we can benefit by owning these two kinds of real estate. What don't we like about it? Well, it's not cheap to go out and buy a mall or an airport. And you got to give up a lot of liquidity. You know all this stuff from previous conversations. What do we like about it? Well, there you go. Income and the potential for appreciation. Now, how about switching over to the floor of the New York Stock Exchange? What can we do? I mean, we can invest in a well-diversified portfolio of equity securities that are selected based on their ability to act as hedges against inflation, meaning that their returns will outpace inflation over the long term. What we can do is go back to that Fama and French factor model that we did back in level 2, and oh my gosh, there's no doubt I would ask this question. I would say, let's remember Fama and French. What did they do, et cetera, et cetera. What's the advantage, right? Dividends, capital appreciation. And of course, we always have to worry about high volatility. I'm not a big fan of this next line, borrowing. Use borrowed funds to invest in inflation-protected assets. I sure hope that we would never go ahead and say, you know what, let's take out a home equity loan, and then let's use the proceeds of that home equity loan to go ahead and buy some of those ILBs. Of course, look at the disadvantage. It introduces leverage. That means we have financial risk. That means we introduce the specter of bankruptcy. You always have to worry about interest rates and borrowing costs. But the advantage, and this is going to be a key as we move through the second LOS in this section here, is that if we have clients scattered throughout the world with their investments, that it might be possible to borrow one currency and pay back in another currency. We've had some really good conversations about investment returns and taxes. What did we say in that previous slide deck? You know, what do we want to do? We want to maximize after-tax wealth, end of period after-tax wealth. So what we know is that, of course, taxes are based on nominal income rather than real returns or real income. So we need to consider the impact of inflation on all of those returns. Let's work through an example here. 10% pre-tax return, 30% capital gains. So let's do a couple of scenarios here. Let's suppose we have no inflation and a nominal pre-tax return of 10%. So if we invest $1, that means that we'll have $1.10 at the end of the year, but we'll have to pay 3 cents on that 10 cents of income or return. So we're left with an after-tax future value of $1.07. That should make perfect sense. Notice there on the left-hand side of the multiplication sign, we're just compounding 1 plus that 10%. And then we're multiplying it by 1 minus the tax rate. That gets us our 1.07. But now, if we have inflation of 5%, that means that the nominal return is going to go up to 15%. So our after-tax return, notice there in the middle line, we've got the nominal after tax is 1.105, but we need to adjust that for the rate of inflation. So divide that by 1 plus the rate of inflation, and you get 1.052. So look at these two scenarios to help you answer a question. Which would you rather have? Not that this is a great question. Of course, you'd rather have no inflation and low tax rate. But here down the bottom, if you have inflation, then those nominal returns are going to have to, and we learned this from the Irving Fisher effect way back in level 1, those nominal returns are going to have to be in excess of the rate of inflation. Let's move to this last LOS on exchange rates. So a couple of interesting things in those 4 boxes up there. And I think these are really, really good sentences to put into the case or the vignette. Families, cross-border assets, cross-border liabilities, they may they may be exposed to substantial currency risk or exchange rate risk. Now, of course, why are we doing this? As good wealth managers, we're going to tell our clients, hey, you know what, go ahead, let's go invest in Canada and in Iceland and Japan. Diversification, we know all about that, diversification. So the consequence of geographically diversifying are different kinds of political and economic risks that are out there. So look in purple. As good wealth managers, we ought to recommend stable political environments, stable economies, although I'm not quite sure what that means. I don't even know if the US economy is stable anymore. All right, so we're going to do what's in the purple to try to mitigate that exchange rate risk, and then look at the consequence over there on the far right. Exchange rate movements can significantly impact, all sorts of things. Here's the example that I give my students all the time. I've probably done this in level 1, level 2, maybe even in level 3. Suppose we've got a high net worth family here in Pennsylvania, and we decide that we have the potential for investing in Canada. Suppose we can get 10% here in the United States, so we have $100 today. So at the end of the year, we have $110. All right, let's forget about inflation and real and nominal returns just for now. We have $110. But suppose that we convert those US dollars to Canadian dollars, and just for kicks and giggles, as my cousin says, let's suppose the exchange rate is unitary. 1 US dollar buys me 1 Canadian dollar. So what we can do is we can invest that 100 Canadian dollars somewhere. Suppose we can get 120 Canadian dollars. Well, a year from now, when that Canadian security matures, or we sell it, what are we going to convert it to? Well, we need to compare it to that 110 that we know we get here in the United States. Well, maybe we'll convert it back to 105. Maybe we'll convert it back to 115. Maybe we'll convert it back to 125. This is exchange rate risk, and it depends entirely on the difference between the rate of inflation in Canada and the rate of inflation in the United States. Do you see why it was so important back in level 1? And I hope that I said this. I know I said this in that level 1 video. Look, we need to do economics. It might not be the most exciting thing. I mean, it's fairly exciting for me. But for most people, it's not too terribly exciting. We need to know all this stuff about inflation and nominal rates so that when we get to level 3, we can answer all of these really, really good questions. So look down at the bottom. What are these impacts on wealth management and planning? Well, look down at the bottom. Currency mismatches can threaten long-term financial goals. All right, so this, I'm going to repeat this again. So what did we do? We did some hedging. I related it to immunization. I'm going to do the same thing here. When we have a currency mismatch, we're not immunizing. Now, the financial world doesn't use the term immunizing for currency mismatches, but it's the same kind of a concept. So if we have a bunch of investments in the Canadian dollar and a bunch of investments in the euro, well, if we have a mismatch, whether it's assets or liabilities, whatever that mismatch is, well, then when we convert, we could lose on both sides. That's why the Institute writes that, threaten long-term financial goals. Look in the purple. That's what I was saying earlier. We have 120 Canadian dollars and we convert it back. Suppose we convert it back to 80 US dollars. And we're looking at ourselves and all of our neighbors, they're celebrating because they have $110 and we only have $80. And we're scratching our heads. We're thinking, oh my gosh, how could we have been so stupid? Now go ahead and look up in the black. Yes, so if we have consumption goals, if we have investment goals in all of these different countries, and let's face it, we're an ultra high net worth client, so our decisions can be impactful. Yeah, this can create exchange rate risk. And then the human capital, all that conversation we had in that last recording. All right, how do we mitigate exchange rate risk? Mitigate means to lessen. It doesn't mean to eliminate. If we want to eliminate it, well, then we could do a whole bunch of different things. But that's not what this LOS is asking us to do. So what we're going to do is one of these 4 things, and I think these are really great potential exam. Each one of these is a great potential exam question. So So we want to diversify currency exposure. So we said this earlier. So what do? We invest in Canada that has one inflation rate, and we invest in Europe that has another inflation rate. But what we're hoping is that those currency baskets of investments, that those currency fluctuations, the Canadian dollar and the euro, they offset each other. So if the Canadian dollar depreciates, that's bad news for us here in the United States. If the euro appreciates, that's good news for us in the United States. But how do we get those two to balance? Well, we identify, and we can do this through a hedge ratio like we did just a minute ago. We look at the Canadian dollar and the euro, and we decide how much are we going to invest in each of those so that inflation is wiped out. So whatever we win in one currency, we lose in the other, and vice versa. Now we can overlay our currency technique. We can say, you know what, we're going to invest 6% of our wealth over here. Where are we? In Europe over here. And 4% of our wealth over here in Canada. So we're going to overlay those. Those are independent asset allocations, and that's going to couple with what we did in the orange above. We can do futures contracts. I mean, there's futures contracts on the Canadian dollar, futures contracts on the euro. There are forward contracts. There are swap contracts. So I wouldn't limit that third line there to just futures contracts. If I'm writing this out in an essay question, I'm going to go ahead and write, we can use forward contracts. We can use swap contracts. We can use futures contracts. We can use almost any derivative that's out there. And then, remember I said earlier that I always struggle about taking out loans, but there's one scenario that is probably okay. If we could go to Canada and take out a loan in Canada, and we're going to be paying an interest rate there. And what is that interest rate? What is that correlation coefficient with the interest rate over here in Europe? So we can take loans we can make loans and take loans. We can be the borrower and the lender in different markets so that we can offset that currency risk. And that takes us through the final two LOSs here. That's why we called this part 2. So I want you to go, I think there are 3 cases that you didn't do back for human capital. You did 2 cases there, right? So now there are 3 cases. So you probably need about 20 minutes on those. So hey, thanks for watching, and good luck studying.